You ready? Okay. So, everyone, please. This is lecture number 4. We continue with the example, or which is what we call a problem there. And I'll give you something similar like this for the exam. Okay. And we have a number of things. There's a repair shop, starts on May 1 by Nancy, okay? And you are asked to prepare a table like this, okay, of the following transactions. Here's number 1. Nancy takes 10,000 and invests it to start the repair shop. So, you have now assets, okay, liabilities, equity, and now the question is, when 10,000 is invested, what changes? Well, right now there's absolutely nothing here. So, the business begins with 10,000 capital. 10,000 capital. So, cash increases to 10,000, okay? So, cash goes up 10,000, it's the investment. Receivable, no change. Equipment, no change. Accounts payable, no change. And it's got, we call it capital. You see how they say equity and then they say capital, same thing. And capital, 10,000. So, you will get 10,000 cash, cash goes up, and equity goes up by 10,000, and we see how it goes. You see, 10,000 cash goes up, and then you have 10,000 cash for this. And that's the transaction. Cash, 10,000 up, and equity, 10,000 up. Okay? So, you always have to think in terms of going up or going down. Okay? Because later we will use for this debit and credit, okay, which is coming next time. So cash up 10,000 and equity. So now transaction number 2. Let's see what's number 2. And before that, when you say 10,000, 10,000, you write on the side the type of transaction. What happened? It's just investment. Hopefully we get to number 2. Number 2, purchase equipment for 5,000 cash. So when you buy equipment, equipment goes up for 5,000. Okay? So you see cash, accounts receivable, so equipment will be plus 5,000, okay? Equipment, we say goes up, means plus 5,000. And when you say purchased equipment for cash, 5,000, this means you spend 5,000 cash, means cash going down 5,000. So, it should be cash minus 5,000, you spend cash, and equipment plus 5,000. This is example where one asset goes down, another asset goes up. The previous example was asset go up, equity go up. Okay? So, cash minus 5,000, equipment plus 5,000. And then it says purchase equipment here. Let's see what happens now. Minus 5,000, here plus 5,000. Plus, and their equipment or purchase equipment. Nothing. Okay, number 3. So, you see how we say 1, this 3 corresponds to this 3 here, okay? So the numbers correspond. Pay 400 cash for rent. Pay 400 cash for rent. So, if you pay, means pay 400 cash, means cash goes down. So this will be minus 400. Asset, nothing here. Equipment, nothing here. Liability, nothing here. And this one will be equity. So, paying cash for office rent is an expense, is a rent expense. An expense reduces equity. So, this will be minus 400, and this one here, minus 400. And this one should be rent. Let's see what happens now. Minus 400, okay, lucky. Over there, minus 400, and maybe rent, maybe. Okay, it's a rent expense, okay? They should have here purchase equipment, okay? But that's okay. Is it fairly clear, this one? Somebody said slowly, slowly, yeah? Why what? Okay, well, first of all, here, for the cash, 400, you pay cash, okay? It is because expense means equity going down. This is from 2 or 3 or 4 slides ago, where we had that equity is increased by revenue, and equity decreased by expense. Do you remember that slide? We have how many slides ago? Can anyone come up with the number of slides? Slide number, what number is that? You remember? Okay, slide, everybody. Everybody, slide number 27. Owner's equity. Asking your classmate. Owner's equity. Decrease. Decrease means going down. When you have expense. Okay. Is that fairly clear? So, owner's equity, expense means going down. So when you have an expense, you put minus to owner equity. Owner equity going down. Okay, so rent expense, equity going down. Number 4. Number 4. This 4 corresponding to this 4. Receiving 5,100 from customers. If it's received from customers for service, you receive from service, it means revenue, okay? And you receive, I assume it's 5,000 from customers for cash, okay? So, you receive 5,000 cash, it should be plus 5,100 cash. So, cash goes up 5,100. And for customer, for service, for repair service, it means it's a service revenue, okay? So, if it's revenue, it should be here plus 5,100 revenue, okay? So, plus 500. So, we have a transaction where this is plus and this is plus. Okay, let's see what happened. Cash. Okay, lucky. And then over here, equity plus. Okay, equity plus. And then there should be another one, revenue. Okay, lucky again. Alright, is that fairly clear?
Yeah.
Questions? Move on. Number 5. Number 5. Withdraw 1,000 cash for personal use. So, withdraw cash is the exactly opposite of invest cash, okay? So, investing cash is plus sign, withdraw cash is minus. So, the business paying cash, cash going down. minus 1,000 cash, nothing here, nothing here, nothing here. Equity going
Cash.
down by 1,000. So minus 1,000. Let's check. Minus 1,000, minus 1,000. Drawing. Okay, drawing. Drawing is the same as dividend. I was explaining. Okay. Or we sometimes say capital withdrawal. Okay. Number 5 was easy. Number 6, paid part-time employee salaries of 2,000. So when you're paying a salary, it's called a salary expense. Okay? So salary is an expense, so it will be at the equity, and the equity goes down by 2,000. And you pay salary, it's paid by cash. It's usually minus 2,000. So minus 2,000,
Going down.
minus 2,000. And let's see what happens. Minus 2,000, minus 2,000, and expense. We call this salary expense. Okay? All right, next one.
Yeah.
Good enough? Number 7. Incur 250 of advertising costs. Now, remember when we say the definition of expense is a cost, okay? So, usually cost will usually mean expense, but not always, okay? Because it may be purchase computer cost 1,000, okay? And if you purchase computer for 1,000 or purchase computer for 10,000, it is not an expense. It is one asset going down, equipment going up, okay? So, it depends the cost of what, okay? If it's the cost of another asset, then it's not an expense, okay? In this particular case, it is the cost of advertising. Oh, and it is on account. On account means don't pay now, means paying later. So, first of all, incur 2,000 advertising costs.
Account payable.
On account. If it's on account, it's going to be account payable. Account payable is money that must be paid to suppliers for goods or services received. So, this one will go up. Let's make sure. Incur 2,000 of advertising costs. Oh no, this is expense. Yes, expense means that incur 2,000 of advertising cost on account. It's an expense. So this one will be going down. And this one will be going up. So this one plus, what is it? 250, and this one minus 250. And then 0. Plus 250 minus 250. 250 is 0. So, plus 250 minus 250. Plus 250 minus 250. Expense. Number 8. Provided 750 of repair services on account. Repair service is a revenue. If it's a revenue, 750 will be plus 750 for the equity. Okay? So revenue is the same as this revenue. Plus 750, and it's on account. If it's on account, it's here. Accounts receivable is when you provide good or service, and you will be collecting the money later. So this is you, the business gets paid later, and this is you pay others later. So this others pay you, and this you pay others. So This is provided service. This one goes up 750 and this one goes up 750. Okay? Up 750. Alright? Plus 750, plus 750. And you see now how expense minus, expense minus, expense minus, expense minus, revenue plus sign. It's going to be revenue plus sign. Revenue plus sign. Okay? You also have to have investment plus sign. Drawing or dividend minus sign. Okay? You see the signs correspond. Alright, let's see what else. Collected 120 cash for services previously billed. Previously billed means that before you had account receivable. Okay? Before you had account receivable. Collect cash means cash going up 120. And before account receivable means account receivable going down. Means they owe you before and now they owe less. Okay? So cash going up, account receivable going down. Should be like that. 120. Cash up 120 minus 120. Okay? And it is collection of cash receiving. Let's see what they write here. They don't write anything. They just now provide totals. And the total is 10,000 minus 5 is 5,000. Okay? Minus 4 is 4,600. Plus 5,1 is, what is it? 9,700. Okay? Plus minus this, 6,820. Okay? This one is easy. 750 minus 120, 630. Okay? 5,000 becomes 5,000. This one is 250 becomes 250. And this one you add up the number. 10,000 minus 4 plus 5,1 minus 1 minus 2 minus this plus this. Okay? You can actually check. Now, you can also check, or meaning double check, by adding this number, 6,820 plus 630 makes 7,450. 7 and 5 is 12,450. And this is 12,450. So 12,450, 12,450. All numbers add up. Okay? So this is one simple example. And then we will continue with debit and credit. But now you can see cash. This is called ending balance. Ending balance. Okay? Ending balance, ending balance, ending balance. I'll explain it. Okay. And finally, we have, let me just, all right, everybody guys, pay attention for the 4 financial statements to explain each one of them quickly for today. 4. First one we always prepare is the income statement. Remember, when you prepare financial statements, this one is always first. And you cannot prepare this without this, okay? You need this to prepare this. So the first one is income statement. Second one is owner's equity. And I just gave you example. This is what the owner's equity looks like. So you make one especially for owner's equity. You make one for expenses and revenues. So the income statement is statement about expenses and revenues. The owner's equity is about expenses, revenues, investments, and withdrawals. The 4, okay? balance sheet is about assets, liabilities, and owner's equity. So, you need revenues and expenses to prepare the equity. You need the equity to prepare the balance sheet. And then you have statement of cash flows. In statement of cash flows is literally how much cash coming in, how much cash coming out. Because you want to have cash. You want to make payment in cash. All right. Review question. Net income will result during a time period when? And we'll look at net income. Net income is like profit, okay? Net income is the same as profit. And net income is usually revenue minus expenses when revenues are more than expenses. So it says assets exceed liabilities, no. Assets exceed revenues, no. Expenses exceed revenues, no. It's D. Revenues exceed expenses. So it should be this one. Okay? So, net income. Income is about revenues and expenses. Okay? And assets and liabilities, the difference is equity. Oh, good. You guys ready? Going to continue? I've got a few more minutes. Everybody, all right. Let's continue, okay? You're going to have after that time. You also should read before, okay? So, here's what an income statement looks like, okay? First of all, income statement reports the revenues and expenses. So, income statement reporting revenues, and revenues is money coming in, and expense is money going out, okay? Revenue is expensive for a specific period of time. For 1 week, or for 1 month, for 3 months, for 6 months, or for a full year. The most common one for small businesses every month. At the end of the month, you want to see how much you make money, you know, how much you made. So, the income statement is about making money, which we call profit. If it's positive number, we call profit. If it's a negative number, we call loss. So, when revenue is greater than expense, profit. If it's expense more than revenue, we call loss. Second, again, revenues, net income. Oh yeah, net income same as profit, okay? So we say net income. And net loss is same as loss, okay? So loss is the same as net loss. Net usually means after taking out all expenses. This is what the word net means. Net means after you subtract all expenses. So, usually income statement will have revenues one part, expenses another part, and at the end it's going to be net income. Sometimes could be loss. And if it's a loss, it will be a negative number. You write negative or you write brackets. That's coming soon. So, revenue. Service revenue, 5,850. Okay. And expenses. Salary expense, 2,000. Rent expense, 400. Advertising expense, 250. And have total expenses. So, you will get revenues and you have total revenue. You'll have expenses, you get total expenses, and then you take total revenue minus total expenses, and you get the net income if it's a positive number, or you get a net loss if it's a negative. And that's a simple, easy income statement. Aha! Now we get how, and here is the connection. That's why I explained to you. That's why we first do the income statement, and then we do the owner's equity. We do the owner's equity because we take the net income number here, we take this number, and we copy this number here, okay? So this number, 3,200, is coming from the income statement. Okay, that's why I told you, you cannot prepare this before you prepare this. Okay, you can't do that. Okay, you first do this, then this. And what do you have for owner's equity? Owner's equity's got three parts: investment, net income, and drawings. Drawings as in dividends. Okay, so investment increases, net income increases, or if it's a net loss, decreases, and drawings decrease. So it is investment, net income, and drawing. And that's all it is. Very simple. Here you also have the initial capital. Initial capital in this particular case was 0. Business got started. Before the business began, it had 0 capital. So, next month, you will begin with this number. You will add investment. You will add profit, subtract loss, and subtract the drawing. Okay? This time, because business is brand new, at 0 capital, no capital to start with. So you say old capital, add investment, add profit, subtract the dividend. They call it drawings. Okay? That's it. That's everything there is. So, old capital, add profit, add investment, subtract. And that's it. That's everything. 10,000 plus 3,000, 13,2 minus 1,000, 22. 12,2. That's it. Next one. Owner's equity. Okay. The owner's equity continues, simply indicates why owner's equity increased or decreased. It's a simple explanation of what happened to the owner. So, if you own a little restaurant, this is the most important piece for you. You want to know how much capital you started, how much profit you made, what investments you make, how much money you take out, and what's your capital at the end of the month. So, as an owner of a business, this shows you your ownership, how your ownership, meaning how your capital changed during the period. That's it. That's all the rest is. And finally, see how the arrow goes here. You take the owner's capital, or the owner's equity, you take the last number, and you put it back in the balance sheet. So, balance sheet gives you all assets, cash, accounts receivable, equipment, and total assets, and then gives you liabilities, as in accounts payable, and owner's equity. Well, owner's equity, this number here, you copy from here. That's why when you make financial statements, you always finish with the balance sheet. You do first the income statement to get the net income, profit or loss. Then you create the capital statement or owner's equity statement. And when you get the owner's equity, you can create the balance sheet. And if everything's correct, the total number of assets, 12,450, must equal to the total liabilities and equity, 12,450. And that's by comparing these two numbers, you know everything's correct. Okay? So you work step by step by step, and then if the numbers are correct, this number should equal this number. Okay? And that's an example, and I will give you on the quiz a similar example like this one. Let's see what else we have. Okay. Explanation now. This is the balance sheet. Alright? Balance sheet reports the assets, liabilities, and owner's equity. These are the assets, the liabilities, and owner's equity at a specific date. So it is done on Christmas, or it's done on December 31st, okay? So on a particular date. So notice, everyone, pay attention, this is very tricky to remember. Income statement is for a period of time, 1 month, okay? Balance sheet is at the end of the month. So balance sheet is for 1 moment, okay? Income statement is all the customers, all the revenues, and all the expenses for 1 month. The balance sheet is only at the end of the month, okay? And that's very important to understand, okay? So you can have income statement for January, income statement for February, income statement for a month, and then have a balance sheet for end of month. Okay? Like March 31st, okay? January, February, March, and then March 31st, you got the income statement, okay? Oh, sorry, the balance sheet. Then you have January statement, February statement, March statement, or you can have for 3 months the income statement, okay? So, income statement could be for 1 day, for 1 week, for 1 month, for 3 months, for 6 months, while balance sheet is only end of January, end of today, end of this week, end of this month, end of this quarter, end of this year, okay? So balance sheet, 1 point. And finally, more. Assets are listed at the top. That's the American convention. In American style accounting, we always begin with assets. Then we always write liabilities. And then we always finish with owner's equity. Okay? Sometimes we write assets on the left, liabilities and owner's equity on the right. That's possible. We'll see examples later. Okay? But it's always number 1, number 2, number 3. Okay? Or number 1, number 2, number 3. Always in this order. And finally, I already explained. Total assets is this number. Total assets, 12,450. Equals or must equal total liabilities and owner's equity. Liabilities and owner's equity, 12,450. This number must equal this number. So when you do accounting, you do this number separately, and you do this number separately and independently, and the two numbers must be correct. If they are equal, means you did a good, correct work. If they're not equal, then something was wrong. Usually what accountants do is they do the one number, they do the other number, they compare, they see the difference, and they look to find the difference. They look to find something wasn't right. We did not account for some asset, we did not account for some liability. Okay? And that's usually what takes a lot of time at the end. So it's usually when you solve the problem, you can solve it for only 20 minutes. And if the numbers are different, it can take half hour. It takes more time to find where you made the mistake, okay? But by knowing the difference, you know what to look for, okay? You know to look for 100 or 1,000 or 3,000, okay? Or maybe something like a minus and a plus, okay? You got the wrong number, you subtract it, you add it, okay? Minus or plus sign. And from here, you do the statement of cash flow. You see how we take cash? This number here, which is this number here. It's got to be the same number. And cash flows is actually very simple. Here, they make it a little bit more complicated, so I'll explain this. Cash flow is basically cash coming in and cash going out. And in accounting and in finance, they like to separate all cash flows in 3 groups. Group number 1 is operating activities, meaning the main line of business. For a restaurant, it will just mean customers coming in, okay? For this university, the main operating business is students paying tuition. That's the main line of business. You pay tuition and fees, okay? So, cash flow from operating. The other one is cash flow from investing activity. If you buy a building, investment activity will be build a gym, build a pool, buy a car, build a new building. So investment activity is associated with acquiring an asset which you're going to use for many years. Okay? Swimming pool, you use 5, 10, 20 years. Or a brand new building you're going to use for 5 to 20 years. Okay? Or something that will take many years of usage. Okay? So that's investing activity. Financing activity is associated, usually, see, investment by owners is associated with owners and with creditors. So, you take a loan from the bank, it's a financing activity, okay? You take investment from the owners, it's a financing activity. So, all business operations are divided into operating activities, investing activities, and financing activity. And here's the key. Investment here means purchasing a long-term asset. So investment means one restaurant purchases another restaurant, okay? That's why another very confusing word in finance and very confusing word in economics and accounting is investment, okay? People think differently about investment from accounting, from finance and economics. Here, investment means the purchase of a long-term asset, okay? That's investment. Financing means loans, bonds, or owners. And you separate it. Cash from operating activities. Cash flow will be cash receipts, same as revenue. The word receipt means money coming in from the word receiving, okay? Cash paid. So receipt is always from revenue, okay? That's why you just say revenue, and this one just say expenses. And this operating activities is the main line of business, okay? The main thing. Investing is purchase of equipment. Investing is purchase of a new luxury car, okay? Investment is purchase of a camera. Investment will be purchase, in this case, of equipment, of a projector, okay? So all of these represent investment activity. This is acquiring an asset, meaning a long-term asset which you're going to use for many years. You can also have from cash flow from investing activities, for example, when you sell an old car. For example, the president of the university purchases a brand new, what do these guys drive here? Mercedes? Like, no, right? So he buys a brand new Mercedes, right? He's got a cash outflow, minus number, for the new Mercedes. Then he sells the old Mercedes, I don't know, for 20,000 or 50,000 or 100,000, right? He gets a little bit of money from the old one. So when you have a brand new Mercedes, okay, it's a cash outflow. You pay money to get the Mercedes. When you sell the old one, you get cash inflow, okay? And see also what they do here. They put in the little bracket. The little bracket means minus number, means negative number. So it is 5,220 minus, maybe try to zoom a little bit, huh? You're trying to zoom in a little bit with the camera? No zooming? So 5,220 minus 2,400 is 2,820, okay? Just a little bit, we don't have to zoom too much. Second, cash flow from investing. You purchase equipment. This means you spend money, okay? So, the numbers in the bracket means spending money, means cash flow going, or we call it cash outflow. All right, let's define this. When cash flow, money comes in, we say cash inflow. When cash is going out, we say cash outflow. So, inflow is positive number, outflow is negative number. Outflow, we use minus or we use brackets. You have to use always minus, 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 or you have to use always bracket, 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 okay? So, you use brackets for negative or instead of negative. And then you have cash flow from financing. You have investment of 10,000. This is money coming in. We say cash inflow. You have dividend or drawing by owner coming out. And then you have separate cash flow from operating activities, 2,000. Then you have cash flow from financing activities, 9,000. And then you have, let's say, financing, and then you have for owners. So cash flow from operating, from investing, and from financing. Okay? So investing is only this number. All right? And it gives you the final number over here. And this final number, 6,820, must equal this one here, 6,820 from the balance sheet. So the numbers must correspond. Okay, let's see what else we have to finish. So, statement of cash flow is always for a specific period of time. For January or February, money coming in, money going out. It tells you the following. Where did cash come from? We call this cash inflow. Sources of cash coming in. What was cash used for? In other words, where did cash go out? Sources of or cash outflow. And what was the change in the balance? Did cash go up or cash go down? Okay? Sometimes business will make some money, and then they say, well, why if we make so much money, at the end of the month we got less cash? And the answer is, maybe you purchase equipment. You buy a brand new Mercedes. Of course, your cash is going to go down, right? You make money, but you convert your profit into Mercedes. Or you take dividend out, okay? You just take the money out to pay for your house or for something else. So sometimes businessmen wonder why we make such a good month, so much profit, and then there's so little cash. And the answer is, this is the profit from the business, you either purchase something like a business car or you buy a second restaurant, okay? In other words, this is like reinvesting in your own business, or you took the money out and spend it on vacation or something else. You buy yourself a house or something else. So, it tells you what is the cash balance and explains why your cash goes up or cash goes down. Review question. Okay. Which of the following statements is prepared for a specific date? And I already explained, the balance sheet is for a specific date. This is for a period, this is for a period, this is for a period. Is it over? Company's net income, okay. Okay, finally, you can get a lot of jobs in accounting. You got jobs in government, as many as you want. It can be hotel, it can be restaurant, computer, software, you name any kind of business. The most common job in the world is accounting, okay? If you do a good accounting, you can always find a job as an accountant, okay? Accounting is the easiest job to find. All right, good enough.